Good morning, traders. Today is Monday, April 22, 2024, and here are key things you need to know. For today, the US dollar index saw fluctuations last week, ending slightly lower but poised to test higher levels. Factors like tensions in the Middle East and the hawkish sentiments from the Federal Reserve are boosting demand for the dollar. The technical analysis indicates a strong upward trend, with the dollar surpassing key resistance levels and showing potential for further gains. However, the fluctuations in the US Treasury yields and the geopolitical tensions could influence its trajectory. Monitoring these factors will be crucial for gauging the dollar's future movements as it continues to be viewed as a safe haven asset. After the release of the US CPI data on October 4th, the US dollar index surged from 103.97 to 105.3, its highest level since March last year. This marked the largest single-day increase since the 7th, setting the stage for further gains. With the market no longer expecting interest rate cuts this year, the dollar has been steadily rising, overcoming resistance at various levels. Currently, it sits above the key moving averages and the Fibonacci bounce levels, indicating a strong upward momentum. Despite a divergence between the US Treasury yields and the dollar, the short-term targets suggest further gains, with the tensions on level around 106.61 and 107.17. On the downside, support is seen around 105.7 and 107.75, with additional levels at 105.38 and 105. For the WTI spot crude oil, after the US trading began, the WTI oil sell-off faded, with price dipping below $82 after breaking the key $84 level. The US dollar index rose above 106 due to positive gold data, while weak economic indicators and progress in the Middle East eased the oil prices by about 3% midweek. The market focus shifted toward the Middle East developments amid the economic challenges, leading to a correction in the oil prices after months of gains. Expectations of the extended Federal Reserve interest rates and the limited US oil inventories influenced the recent declines, despite geopolitical tensions. However, unless new risks emerge, the conflict in the Middle East isn't expected to lead to significant sanctions on Iran's oil exports. Despite some profit-taking adjustments early in this week, the oil prices overall are still bullish. If the prices break below 81.1, bears may target the 80% threshold. However, with the Middle East situation in focus, the downward movement is expected to be limited, with the bulls are aiming to surpass 84 and 84.42 levels, eyeing last week's high of 87.12 and then 89.64. The gold prices for today rose over 2% last week, reaching as high as 2,417.8 per ounce. This marks the fifth consecutive weeks of gains, starting in January 2023. The prices surged after the Israeli airstrikes on Iranian cities but fell back after the Tehran indicated no plans for retaliation. The market focus remains on the situation in the Middle East, with the gold upward trends dependent on the safe haven demand and the Federal Reserve rate cut expectations. If the tensions ease, gold prices may retreat, but the market is cautious about the situation's severity for now. Last week, the gold prices surged to 2,417.8 due to tensions between Israel and Iran, but closed around $2,390 by the weekend. Gold is now aiming to stay above the key 2,400 resistance level. However, its upward momentum is restrained by hawkish signals from the Fed Reserve. Despite this, the geopolitical uncertainty is still driving buying interest. The momentum oscillator has cooled off after being heavily overbought, with the RSI slightly declining from its peak. While the broader demand remains strong, the RSI is within the bullish range. Potential targets for further gains include 2,417.8 and 2,431.5, while the major support levels lie at 2,360 and 2,363. A breakout could test lower levels around 2340.9 and 2300. And then for the AUD USD, over the weekend, the AUD USD exchange rate dropped to 0.6362, its lowest since November, following Israeli airstrikes on Iran. However, concerns eased after the Iran reported no significant damage to its nuclear facility. The Australian dollar rebounded, supported by gains above the 0.64 level. While the attack hasn't been confirmed by Israel, the US officials acknowledged it, suggesting limited scale. Meanwhile, the weak Australian employment data for the March fueled speculation of early interest rate cuts by the Reserve Bank of Australia. Despite a slight increase in the job seekers hired in February, March saw a decrease of 6,600 workers, with the unemployment rate rising to 3.8%. With the ASX 200 index nearing a 2-month low, the Australian dollar faces challenges. The Australian dollar recovered some losses as tensions between the Iran and Israel eased, with Iranian officials indicating no immediate retaliation plans. Previously, the pair had dropped to around 0.6362, its lowest since November. However, it bounced back above to the 0.64 mark, yet breaking below the 0.64 on the daily chart signals a strengthening bearish trend. The 14-day RSI suggests a bearish sentiment with an index at 37.73. The key support levels include 0.6362 and 0.636, followed by 0.63 and 0.627. On the upside, resistance is expected at 0.6445 and 0.645, with potential higher targets at 0.6499 and around 0.65. Last week, the GBP USD dropped to a nearly 5-month low of 1.2361 as the dollar strength gained strength amid reports of an Israeli missile attack on Iran, though Israel hasn't confirmed anything yet. Market sentiment improved as concerns eased over further escalation in the Iran-Israel conflict. The Atlanta Fed President Raphael Bostic mentioned that the progress towards the 2% inflation target might be slower than expected and expressed comfort with maintaining high interest rates due to strong labor demand and resilient wage growth. The UK retail sales report for March showed stagnant growth month on month, with declines in food and non-store retail sales offset by spending on fuel and non-food items. The pair fell below its downtrend channel before last week's end, hitting a 5-month low of 1.2361. The long-term outlook remains bearish, with the pair staying below the 200-day moving average at 1.2572. A death cross pattern formed at the week close, signaling further decline. The 14-day RSI suggests a bearish momentum. Downside targets are around 1.23 and 1.2263. If the sentiment shifts and the buyers regain control, the resistance levels are at 1.24, 1.247, and 1.2481, with the major resistance at 1.2572. Last week, the USD Japan yen initially traded above 154 before dropping to around 153.6, as safe haven demand boosted the Japanese yen. Escalating the tensions in the Middle East following a bomb explosion in Iran, reportedly orchestrated by Israel, spurred a flight to safety. While both the US dollar and Japanese yen benefited from the risk aversion, the yen's rally was more pronounced, driving the USD Japan yen lower. However, the pair later rebounded above 154.5 as the tension eased, with the Iran indicating no immediate retaliation plans. The Bank of Japan Governor Yuda hinted at potential interest rate hikes and bond purchases reductions if the inflation continues to rise. Market focus now shifts to the Bank of Japan policy meetings for insights into future interest rate decisions, alongside new economic growth and inflation forecasts. Last week, the USD Japan yen formed a bearish hanging man pattern on the daily chart, indicating a potential short-term reversal. However, the technical indicators show mixed signals due to an overbought conditions, suggesting uncertainty between bulls and bears. Until a clear downward trend emerges or the overbought conditions subside, a bearish outlook for USD Japan yen remains uncertain. Since breaking through the 152 level earlier this month, the upward potential has opened up with no previous resistance points. The resistant levels to watch include 155.45 and 155.7, with further potential towards 157.74. On the downside, support levels are at 153.6 and 153.7, with further attention on 152.54. The Euro USD is trading in the mid 1.06 after bouncing back from early weakness. The pair initially dropped as conflict in the Middle East spurred demand for safe haven assets like the US dollar. Reports of an explosion in Iran heightened tensions, leading to increased demand for safe haven currencies. The Euro USD fell to 1.061, near its year-to-date low, but has since recovered to around 1.065. Concerns about potential rate cuts by the European Central Bank and expectations of rate cuts by the Federal Reserve later this year are putting pressure on the euro, making it difficult for Euro USD to rise. The Euro USD reversed direction midweek after countering resistance below 1.07 and resumed its short-term downward trend. The pair seems to be fluctuating between the year-to-date low around 1.061 and resistance at 1.07. Both short-term and medium-term trends suggest further weaknesses. The RSI has moved out of its oversold territory, indicating potential for more downside. Breaking below the April low of 1.0601 could embolden bears, targeting the November 2023 low of 1.0516. For bullish momentum, the Euro USD needs to surpass 1.07 and resistance near 1.0712. A truly bullish scenario would involve breaking above the Bollinger pivot at 1.0756, followed by resistance at 1.081. And that is it for today's daily analysis. Thank you so much for watching. And if you have any questions, feel free to comment down below.